A decade after the collapse of Lehman Brothers Bank, we are still feeling the effects. Global recession, the eurozone debt crisis, and long-lasting austerity have all followed. Have the problems gone away? If not, what is to stop it all happening again? You're watching Roundtable with me, David Foster. Now, this massive worldwide financial mess brought with it anger towards big banks and towards governments, given that the fallout led perhaps to Brexit, to the rise of populism, to the arrival of Donald Trump. How much have the rules changed? Are we any more secure? "10 years on and the world still feels the ripples of the Lehman collapse. The massive bailouts of private banks by taxpayers led to years of austerity in the West. This then triggered a social and political push to the extremes of right and left. So how did a small market in American subprime mortgages come to infect the global financial system? And given that experts didn't see it coming, can we trust that they will predict the next crash? In the summer of 2007, the French bank BNP Paribas announced problems with its US mortgage portfolio. It contained what were known as subprime securities. BNP was the canary in the coal mine. This new financial product contained loans that had been sliced up according to their level of risk. The products were then repackaged and sold on to investors who then sold them onto other investors. The aim was to spread the exposure. But when Americans started defaulting on their mortgages, nobody knew where the risk lay. The process of securitization had left European and American banks so intertwined that panic was highly contagious. Queues outside the UK lender Northern Rock were one of the first visible signs of alarm. The run on that bank forced it to be nationalized in early 2008. But the peak of the crisis was the collapse of Lehman Brothers in September 2008. Other banks became even more hesitant about lending to customers. Governments stepped in to reassure the markets and the public.
The American people can remain confident in the soundness and the resilience of our financial system.
They tried to restore public confidence by guaranteeing deposits, buying bank shares and lending them money, until money markets calmed down. One of the main lessons learned from the crisis is that the more capital banks have relative to their risks, the safer the economy as a whole becomes. And as a result, a new global regulatory system called the Third Basel Accord is being rolled out. Its aim is to increase bank liquidity and decrease banking risks. So are the new Basel Accords on bank stress testing and capital enough to stave off the next crisis? And what if the next crisis is not lurking in the mortgage markets? Some experts point to a borrowing binge among risky companies and risky countries. It could be here that the next crisis lies in wait. And I'm very pleased to say that joining me at the round table we have Anastasia Nesvetailova. She's the director of the Political Economy Research Centre at City University London. Jack Aldane here, journalist who's written for several financial outlets. Vicky Pryce, too, with us, the chief economist, or chief economic advisor, I should say, at the Centre for Economics and Business Research, and Catherine McBride, senior economist at the Institute of Economic Affairs. All of you very much steeped in economics as a subject. If we could try and keep it, if it's possible, to a level where we all understand, that would be very helpful. Can I take it as a given, speak now if you disagree with me, that this perhaps led to the rise in populism, to the arrival of Donald Trump, that it led to Brexit, that the domino effect has been extraordinary? You agree?
I think it has, because a number of countries reacted after going first to save the banking system by having to deal then with rather substantial deficits that they inherited as a result of this. And that has led to quite a lot of austerity in a number of countries. Inevitably, there have been people who lost out quite significantly. People at the top still seem to be getting quite big rises, so it has increased resentment. It has also made people feel that they haven't done well since the crisis. Incomes haven't really recovered sufficiently, and they blame others for it, if you like, or the elites. And the result of that is populism.
So was it austerity that was the problem here? If it had been spending your way out of a crisis, that might have made people's lives better?
I'm not sure that that's completely accurate. It was sort of a perfect storm. There were several things happened at the same time. A lot of them were interconnected in the financial services, but you also had other things happening in the general economy. Obviously, since the mid-90s, you've had a NAFTA agreement in the US, so a lot of manufacturing had moved out of the US. Now, that was fine in a buoyant market. People were making money on their houses. They were making money elsewhere. But when, as Warren Buffett famously said, when the tide goes out, you see who's naked in the sea. And so once the music stopped, if you like, there was a lot more hardship, as Vicky said. So then the austerity measures came in, but we had already lost a lot of manufacturing jobs. Also, in the UK's position, we had a mass influx of immigration after that time, where 5 million people came to the UK between 2008 and 2018. We have negative natural increase, and our population went up from 5 million, so they came from somewhere. We were absorbing the unemployed from all over Europe. Obviously, we got a lot of people from Romania and Bulgaria, but we also got a lot of Spanish and Italian and people from countries whose financial environment was worse than ours. And that lowered, any supply. If you increase supply in any business, you lower the price. And so massive increase in supply of workers, because most of the immigrants were workers, they were not children or old people. So we did lower wages, we had austerity, we had less manufacturing jobs, we had kind of multiple things happening at the same time.
I know you want to jump in, but I'm going to have to bring the others in first.
Absolutely. It's just that there was one thing which
Yep.
isn't right. Wages have not been lowered as a result of migration, and we've had a lot of evidence against that.
Okay, well, we'll leave that one out there. Jack, I'm going to come to you in a bit because, like me, you're a professional observer. And Anastasia, I want to quote something from an article by John Lanchester in this week's Sunday Times, in which he said, he wrote a book called Whoops. Immediately after the crash. He said, I spoke to bankers at the time who said that what happened was supposed to be impossible. It was like the tide going out everywhere on Earth simultaneously. So was there a way of avoiding this?
Good question. Depends what. The crisis was quite complex. It involved, it's not just the financial crisis. There was a banking crisis, there was a mortgage crisis, there was an interbank crisis, there was a, if you want, to step to a higher level, it was kind of a crisis of governance of capitalism. The banking crisis was resolved relatively easily. It's the management and the introduction of policies in the wider economy that had produced all the effects that you already mentioned.
Well, was it because everybody believed that greed was good and that therefore it would be okay to continue the way it was?
When I myself speak to bankers, there is a sentiment. The people who were participating in the boom at the time, and let's say they're in their 40s, early 50s now, they genuinely tell me that we thought this is the new age. When they were trading the products, when they didn't even question the relevance of these products to the outside of the economy. The zeitgeist was to trade. This was very much a norm. It's not even a fashion. Now they either left the industry or they have kind of reflected on the usefulness of the innovations.
And yet they were fooling themselves. Look at the Economist here. It says, systemic banking meltdowns are a feature of human history. The IMF says there's been 124 between 1970 and 2007.
That might have been, but nobody expected. So the banking crisis as a banking collapse, as a bank going down and people standing on the street taking deposits out, was supposed to be a feature of the 18th century, where governments, the state, did not have deposit insurance, where we didn't have banking regulation. This was very much out there. It's not described in economic textbooks, certainly not in financial textbooks. When children go out of university, they don't know what to do with the banking crisis. It's not a subject that they taught in their lectures. So, and that's partly why experts, economists, especially professional economists, were completely out of their depth immediately trying to understand. It's only when they realized,
which will lead us, I think, to something I want to discuss a little bit later on, which is the lessons learned and how to avoid it. I've got to bring Jack in at this particular point. You decided you would concentrate on this sort of subject because of what actually happened. What has surprised you about what you've learned as a professional? I described you as a professional observer.
Well, yeah, indeed. I graduated into the financial crisis in 2009. And I suppose what surprised me over the last 10 years is just how easily both politicians and to some extent the media too relies on a certain kind of amnesia culturally, where people forget within cycles of, perhaps between 3 and 5 years, just what it is that made them angry to begin with. We've seen, particularly in the UK, a conversation about the deficit and balancing the books and all of these buzz terms that the coalition government was using around 2011 when it formed, to a conversation about whether the UK should remain a member of the European Union. How did we get from there to there? It sort of has happened through kind of a subterfuge of messages that once explained what was going on but became stale, or perhaps were just too dissatisfying for people to really believe in and stake their hopes on, to what we see today, a sort of populist movement, which, although I think it has managed to grasp and grapple with some problems that were pre-existent to the financial crisis, has become a kind of totalism, sort of a total explanation for what people are going through. And what surprised me is just how easily this can occur within the space of a decade. So, yeah, I think that there's certainly a lot to answer for there in terms of putting across the right explanation for what actually happened in the first place.
I'm sure it's all going to open up a little bit more now because you're going to be questioning each other, etc., etc. But Vicky, let me ask you one thing. You said to one of my producers that you felt that Lehman Brothers should have been saved. Would that have avoided all of this? Biggest bankruptcy in history?
I think it probably would, not all of it, but it certainly would have eased quite significantly what happened afterwards. You talked earlier about the various financial meltdowns that happened before. What used to happen is that the central banks were very close to, and the regulators very close to what was going on in the banking system. They would meet behind closed doors and sort out problems. Loads of banks, one is aware of, had basically become illiquid and probably should have been closed down if there hadn't been for intervention by the banking authorities to make sure that...
They just kept it quiet and kept the surface
sorted it out. And the problem
smooth.
that we've had now, and I think Anastasia has a point, that it was slightly different, is that the interconnectivity of the financial systems across the world is now so great. There's been a huge explosion of investment in assets, foreign assets, international assets that people hold. And a lot of the lending that banks were doing was based again on assets they thought were quite secure. So the moment somebody sneezes in wherever, the US or China, then everyone catches cold. But the monetary authorities should really have been much closer to this and should have sorted it out between them. We thought here in the UK that nobody in their right minds would let Lehman's go because it would cause...
But what was it, $600 billion, I think it was. Could that have been kept quiet?
Well, you shouldn't have got the point where that was so big. And I think that's the lesson, that one should really have intervened a lot earlier and made sure that the system was much more secure.
But it was too entangled, perhaps, to unravel at that
Yeah, I think
point.
there was a real belief by the policymakers that they should exercise this, or at least not allow this moral hazard to develop. In other words, if you save one bank, then everyone else will just behave and think recklessly because they think that fine, the authorities will intervene and save you. So they let Lehman's go. We talked about moral hazard here in the UK as well. You do it with one bank, and because of the interconnectivity, the entire system is in danger. So you save everyone else actually after that. So moral hazard should just be thrown out of the window.
Well, I have a feeling that one of the reasons they didn't save Lehman's is because they had saved long-term capital in the late 90s. I agree that once upon a time, if you go back beyond the 70s, in 1907, I think JP Morgan actually apparently locked all the New York bankers in a room and refused to let them out till they'd sorted out one of the banks that was going under. So it has happened before, and he wasn't even a central banker. But certainly it is tricky, and the government should have thought about it earlier. But I would like to pick up on a point that both Jack and Anastasia made earlier, which is there is a loss of memory, if you like, in the market because of the very flat triangular structure that most of these banks work on. When I started in a dealing room in the 80s, of the 1,000 people that were in the dealing room, you'll find very few of them are still in the business. And every 5 years, there's a new turnover of staff.
They get burnt out, actually. They burn out.
Even if they don't burn out, there are now people who've been working in financial markets for 10 years who've never seen a bear market. Right. They've never even seen interest rates above a couple of percentage points. You know, I went through double-digit interest rates. Right. They don't scare me, but you know, these guys, what are they going to do when interest rates go to...
So other than encouraging a longer-term career path in an industry in which it's quite easy to get burnt out, what has been done and what could be done, perhaps, to prevent something similar happening again?
On what has been done, there are quite a few. So our regulators, there are more of them. They have more powers and they have more data. We cannot say that they know exactly what to do with this data. Mm-hmm. But it's certainly a change to where we were in 2007, where really there are anecdotes going around that somebody in a British supervisory institution wouldn't even read the FT because there are no sport pages there. They kind of, the market was supposed to sort stuff out by itself. So I think there is increased competence, there is increased professionalization at all levels of, and people are actually scared of supervisors now, regulators, mostly of Americans, not so much Europeans and Brits, but the industry is scared. There is more emphasis on compliance. We have learned that we don't know much about systemic risk. This is the stuff that implodes. This is not the individual risk when an institution goes down, but this is where the effects are rippled out. And we also learned that the financial system may not be competent enough to manage that systemic risk.
But did we not also learn, Jack, I'll bring you in on this because you've been looking at this, and I want to ask whether you've been surprised by the fact that nobody really who caused this to happen has been held accountable?
I think that the feeling is that there hasn't been nearly as much of a sort of fallout in terms of retributive justice in that regard. However, I think that what people sense is that there is a fundamental flaw in the current system, which, regardless of who may go to prison or not, needs to be addressed. And I think, to bring it onto economic policy, if I may, for just a brief moment, I think the problem with that at the moment is that it's trying to steer economic policy back to the pre-crisis era. And the problem with this, of course, is that while you can carry on with monetary easing, with macroeconomic stabilization, with austerity measures, a lot of the anger that people are feeling is to do with the fact that this sort of the neoliberal system is flawed, if not failing itself, and that there has to be some way of challenging sort of 20th century orthodoxy with regards to economic policy making that isn't being challenged. So we need a much more brave and creative way of approaching that. So I think regardless of whether or not we see this as a simple matter of justice, who goes to prison and who doesn't, I think what people want to see...
But I was wondering if perhaps it was the something hanging over people, as you said, with the regulators. They're scared of the regulators. People might have been scared of being taken to court and prosecuted for this, because there had been relatively few of these. They felt there was a certain impunity.
There is.
Yes, absolutely.
Yeah.
But well, do you want to?
Sorry, I would say that actually banks have been fined a lot of money. If you look at European banks like Deutsche Bank, for example, but also if you look at some of the UK banks, they've been fined, and some of the pretty international reach in this respect. Because of whatever they did before with the mortgage-backed securities, the way they invested, the way they used that to raise more funds. Barclays, in fact, has undergone all sorts of regulatory
But isn't it a bit like a gnat biting an elephant's bottom?
Well,
it really doesn't make much difference.
Well, it does. In fact, there are a number of Barclays executives who are facing criminal charges, and there is a court case starting next year, if I understand
excuse my ignorance on that, but I
so
thought
there is a certain
the
amount.
system as a whole hadn't been.
But no. You're right overall. But there isn't a huge amount of. I mean, there are directors' duties, of course. I mean, if your board doesn't understand what's actually happening with all the derivatives that are going through the system, then you've got a much more serious problem, as Jack was saying. It's not just that they've done something criminal, it's just that they've done things which they didn't quite understand the impact of.
Banks are the bad boys and everyone hates banks, but they didn't cause this by themselves. I would like to know what's happening to the auditing firms who signed some of this stuff off as AAA or whatever. What happened to the real estate agents who convinced people with virtually no income to buy houses in America? What happened to the property developers who paid bonuses to the real estate agents who sold property to people with no income? There was a whole chain of events. This was not bankers just inventing something by themselves in a vacuum.
Has austerity been proven to be the wrong answer in this case?
I think so. I think theoretically...
Has it worked in any case?
No. Well, it might have worked in a hyperinflationary scenario in Latin America back in the early 80s or mid-80s, but it doesn't work in an environment of low, basically deflationary scenario where things are just going down, where nobody wants to employ more people, nobody wants to pay higher wages, inflation is low, interest rates are low. We're in a very different economic reality.
Except
and
that
austerity.
employment has gone up.
Yes, a little bit, but people are still not getting paid more.
No, that I agree with you.
Where's the next
unlikely.
crisis coming from? As I say, times are
You can
enemy.
take your pick. It could be fintech, it could be real estate, it could be unsecured consumer borrowing, it could be shadow banks, it could be Turkey going down or something happening in China. It could be a combination of any of these things. So, but we're very ripe for that.
It might be the wrong way of putting this, Jack,
combination.
but where's your money?
Okay, well,
Where's your money not? Yeah.
no, I think that in terms of the next crisis, I mean, to ask whether or not we'll see a global crisis on the scale we saw 10 years ago, I think the answer is no time soon. However, it's important not to conflate a large-scale global crisis with a recession, which I think is more likely, particularly in countries like the UK, as it negotiates its way towards an exit from the EU. But nonetheless, I think that the problem the Western world has still is its emphasis on the property market. And it's still more likely for loans to be extended with property as collateral than simply loans to businesses that need to grow. I think this is a very vulnerable spot in the Western economies. Yes.
And is this where you spoke to me before the program about the money bubble?
Yeah, well, that's actually way beyond personal indebtedness. That's whole countries who have issued bonds. There's something like 96,000 European government bonds out there, 48,000 corporate bonds out there. They're all completely illiquid. And the problem with an illiquid market is when there's a sell-off, there is no bid. You know, it's straight to zero because who's going to stand and catch a falling safe? They don't. So everyone runs. And that is our real problem. Our markets gradually crawl up, but when they come down these days, it's straight down. So
is the real problem here is the fact the people you would expect to learn haven't learned as well?
What you're seeing right now is a divergence of monetary policy. What you had before during the crisis is that everyone cut their rates at the same time and had quantitative easing, so actually massive amount of liquidity in the market to counter some of those austerity problems that we've got now. And that has continued for quite some time. Look at Japan, look at the European Central Bank. The US is now moving to withdraw that money. It's raising rates faster than others. Others are still keeping them quite low. You have impacts of that on the exchange rate. And unfortunately, with trade concerns sort of bubbling up, you have emerging markets, as Anastasia was already suggesting, in serious difficulty because they've basically borrowed in dollar terms, the dollar's going up. They are in serious difficulties, and their currency are depreciating, and their debt.
But isn't it just self-perpetuating, and therefore it's inevitably going to happen again? Because unless you live within your means, you're always going to be in debt, and yet you're encouraged to be in debt because growth is the holy grail, and you have to have money to...
There's nothing wrong with borrowing. I mean, the problem is trying to get yields or returns that are higher than what you get in the West, where interest rates are so low. That's what really gives you that real problem. But the property issues are very important.
Sure, but I think also that there's a problem with the financialization, I should say, of consumption, generally speaking. The fact that, as you say, debt is a way of life. It self-perpetuates. You're always, as it were, painting the fourth bridge with your finances, getting close to getting square.
For those that don't know, that means that once you've finished, you've got to start all over again.
Yes, or that it's a self-perpetuating thing
Yeah.
that never really kind of breaks even. That's how people feel, particularly, I wouldn't just say people of my own generation, but their sense of perpetual debt where you're never quite in the black again, and you're constantly having to start from scratch. That's something which I think is a part and parcel of the current system. I don't think that it is particularly sustainable. We can see how it hasn't been sustainable in the past, and I also think that there is a way of structuring our institutions, financial, regulatory and otherwise, to take account of the fact that our economy is changing. Digitization is fundamentally transforming our economy. It's happening quite slowly.
Could make it worse.
But it could in other ways. But I think one way it could make it better perhaps is simply to not have this war of ideas continually going on between free markets on the one hand and government intervention on the other, to sort of see that the public and private spheres are becoming more enmeshed.
Thank you all very much indeed. It goes far too fast,
Yes.
doesn't it? Money as well as time.
Indeed.
Listen, thank you for coming on the programme. I suppose the answer is don't spend it unless you've got it, but that's never going to happen. That is it in terms of the programme. I doubt that is it in terms of the discussions about where the world stands, whether it has money or not, and whether we're all going to suffer or all get a great deal richer. From me, David Foster, from my guests, thank you for watching this programme on 10 years after the Lehman Brothers collapse. We hope to have your company next time. For now, goodbye.